Okay, accounting for partnerships, Chapter 12. This is Chapter 12 and Chapter 13 is the equity component of the balance sheet that we'll be talking about. And accounting for partnerships, sole proprietorships is very similar to the partnership, and so which is the most predominant form of business in the United States. So let's start with that one. And click. There we go. Again, what is the partnership form of organization? It's a voluntary association, two or more people. It does require a partnership agreement. Unfortunately, most partnerships agreements, a lot of times people get into it orally. Not good. This should be actually a very extensive legal agreement. And I would suggest using very competent and experienced partnership attorneys who are very familiar with this because these can be quite complex. I actually don't, when I was a corporate investment banker, I hated dealing with the partners because more often than not I was a marriage counselor. And the reason is because I didn't have a well-defined partnership agreement. And then they were trying to solve their problems after the problem developed, and it's not a good way to go about it. Key thing about a partnership is limited life. If one of the partners dies or leaves, it's the end of it. You got to reform a new partnership if you're bringing in other partners. Another negative to this thing is unlimited liability. What that means is if you're a partner and your other partner goes to Las Vegas and loses all the money and goes in debt, you're responsible. Okay, this is sort of like a marriage. So it's very risky in that sense. If there's co-ownership of property, all the partners own that partnership. And I'm not going to go into mutual agency. There's some issues with that when is there management versus the limited partners, and it can be a different concept there. And taxation is important. It's taxed at the individual level. The partnership itself does not pay taxes. It just reports the income of each partner, and then the partners individually have to pay taxes. And that's why it's very similar to the sole proprietorship when it comes to taxation. Okay, there are, to make it confusing, a variety of different types of partnerships. I'm not going to hold you accountable to being an expert. It takes some experience, but you should be aware of some basic ones. And the first thing is, which they don't even list, is the general partnership. It's just where everyone is a general partner and has managerial responsibilities. And then you get into limited partnerships. And a limited partnership has two types of partners. A general partner, which assumes the management duties of the partnership, and then the limited partners, which have no personal liability beyond what's invested. They're not part of the management team, so the most they can lose is the money they put into it. Whereas the general partners have management authority and unlimited responsibility. Limited partnerships are very common in the investment world. A lot of investment trusts and so forth are utilized this way. Limited liability, again, it protects innocent partners from malpractice. Some states hold all partners. There are some differences here. The fastest growing, though, in the United States is called the LLC, the Limited Liability Corporation. I myself have been a general partner to a couple limited liability LLCs, and again, they're also very prominent in the investment world. And it's sort of the same kind of features as a limited partner kind of concept, only it has some aspects of a corporation. And so it's a little bit of both worlds in that sense. Again, choosing a business form, as you can see, there are proprietorship. This is known as a sole proprietorship. There's partnerships, LLP, LLC, an S corp, and a corporation. We're going to get into the corporation in Chapter 13. So to organize a partnership, partners can invest both assets and liabilities. For instance, an example of that would be you invest in a contribution to your partnership is maybe the office building. But with the office building also comes the mortgage. And so yes, both assets and liabilities can be inserted into the partnership. Assets and liabilities, when the partners do join, are recorded at agreed upon value, normally a fair market value. Asset contributions increase the partner's capital count as would be expected, and withdrawals decrease it. I think that's pretty common sense in that sense. In accounting for partnerships, partner withdrawals are debited to their own separate withdrawal account. So what you're going to have to do is set up a T account or in your chart of accounts for each partner, because you have to track what's coming in and out for each partner, because they can vary for different amounts for different partners. And again, you're going to be both debiting and crediting depending if there's net income, net loss, withdrawals, or contributions, and so forth. So let's look at one as a couple journal entries here. Here, the person's putting in some cash, maybe a building, and then the note on the building, but the total contribution here is 40,000. The note is a negative 10, so the net contribution is 30,000 to the capital account. Whereas this individual is just depositing cash, and so that goes into the equity and then the asset. Dividend income or loss. Partners are not employees of the partnership, but its owners. That means there are no salaries reported as expenses on the income statement. Profit or losses of the partnership are divided on some agreed upon ratio. And this agreement usually comes in a variety of methods. It can be stated ratios based on capital balances, maybe based on services, capital stated ratios. It can get quite complex, to be very honest with you. And you've got to track that for each partnership. It's not standard. It's basically what each partner was able to negotiate. These can get quite complex sometimes. Allocation of stated ratios. For instance, in this partnership agreement, this individual is to receive 2/3 and this one's 1/3 of the income. Again, maybe this guy's working maybe more hours or something, and that has to be defined in that partnership agreement. So you would just split it out, the income summary of 60,000, and then split out according to the partnership's agreements that's in writing, hopefully. Allocation based on capital accounts. Maybe they should earn an interest level for each capital account. So if one puts in more, he's going to earn more based on that. And so maybe they're going to split it out 75-25. So there's different ways, and it can be a combination of these different things. And so it can, like I said, it can get quite complex. Allocations on services. Maybe there is an annual salary you're going to pay one partner because he's taking a more active role. While it won't be defined as salary, well, it can be, but it'll still be shown as a withdrawal and so forth. And so again, there can be a variety of techniques for structuring this income allocation. And they're just going to go through a variety of ways of calculation here, which I think is easier done by reading than me explaining it. Again, there can be both salaries, there's interest, maybe income allocation, who knows? What if there's only income of 50,000? Again, the partnership agreement will have to define all this of what happens. Financial statements, so you are going to show each partner's, and if you have 25 partners, there's 25 different chart of accounts. Okay, so I've been in partnerships where there's been literally hundreds of limited partners in there, and yes, you track every investor because you have to file a K-1 with the IRS for tax purposes every year. It can get quite complex. Again, job security. Admission or withdrawal of partners. When the makeup of a partnership changes, the existing partnership is dissolved, and then you have to form a new partnership, and it's immediately done. Very common, for instance, in law firms. Law firms more often than not are giant partnerships. And when one partner leaves or retires or dies or something, and you bring in new partners, there's always a new partnership agreement. So, and sometimes you can purchase from other partners, other partnerships out and so forth. So, again, quite complex sometimes. Again, when you're cashing out the partner, the cash goes to the partners, not to the partnership. It gets split out and so forth. Again, you do have to work very closely with the legal documentation of these of different entities, including corporations. So it helps to have a little bit of legal background, to be very candid with you. Again, contributions to different capital and so forth. Maybe you're buying one partner out, and so it's switching to another partner, as an example. Perez is getting taken out, then it's being put in. Again, maybe a new partner is going to contribute assets and so forth. Sometimes you have to buy your way into a partnership, and so be it. Cash, and you just start journaling those. And again, it can be not only in cash, but it could be equipment, buildings, and other assets, maybe copyrights or patents, as an example. Bonuses, that's another way of splitting out the money, and again, that needs to be defined in that agreement. Again, maybe by a percentage of ownership, as one example. But it can be tied to efforts, contribution, commissions. There's a variety of things that you'll have to track. Bonuses, again, here's a bonus and it's split out, maybe, different ways. Bonus to a new partner. Again, this all has to be defined in that partnership agreement. And I'm going to withdrawal of a partner. The partner can sell his partnership to another person, maybe. Usually that has to be defined in the partnership. It might be defined that he can't sell this to anyone, just to existing partners, for example. And or that if they are bringing someone outside, it has to be approved, maybe by the existing partners. Again, it can get quite complex. So just don't take it at its face value here. And then you're withdrawing cash. You're withdrawing their capital account, and you're paying them out in cash. And then the bonuses go out to the remaining partners. So again, everything's going to be defined by that partnership agreement. Partner's death is no different than a withdrawal. Okay. Liquidation, you're going to have to maybe sell the non-cash assets or agree to split it up, maybe. Maybe there's a gain or loss on liquidation that's going to be allocated, maybe using their income and loss ratios. Liabilities have to be repaid, and then any remaining cash is distributed. Sort of, and this is not going to be much different as for a corporation or sole proprietorship. Capital deficiency. This is where the partners have no capital deficiency. Means that all partners have a zero or credit balance in their account, and maybe they choose to dissolve that. It's sort of like going bankrupt, as an example, and it does happen. And you're maybe selling the land, or maybe you're going to allocate it to one partner and so forth. And I'm not going to go through all this. Capital deficiency means that at least one partner has a debit balance, meaning a negative equity position. And at that point, if they're going to cash out, you have to take that negative position and allocate it to the remaining partners. You just don't get to erase it. Otherwise, the balance sheet will be out of balance. And so you do have to reallocate all that. And that's just an example of all that. There's one ratio that's return on equity. This is true of both sole proprietorships or partnerships, or even corporations tend to track some variation of this ratio. And it's just the net income over the partner's equity, whether that be a limited partner or a general partner. So you're going to see some variation of this ratio throughout the semester. That's it for this chapter. We'll get into the chapter 13, which is going to be a lot more complex, because we're going to get into different kind of securities and stocks and so forth, and dividends and board of directors. So we'll see you then.